Trump's big, beautiful bill makes changes to state and local taxes, also known as SALT. And if you itemize your deductions when filing income taxes, this could help you, especially on car or home loans. News Nation's Alicia Nieves breaks it all down for us.
Yeah, we're at a time right now where interest rates are double what they were just 5 years ago for homeowners, those looking to buy a car. The new SALT deduction increase and the auto loan interest deduction that's been added under the One Big Beautiful Bill has the potential to allow millions of Americans to bring more of their hard-earned money home. We're talking about the potential of some of the 80 million Americans who are homeowners, 100 million Americans with outstanding car loans. Both will have their tax liability potentially reduced and again allowing them to keep more of their hard-earned money. Now, for homeowners, the SALT deduction increase, which allows these taxpayers to deduct specific state and local taxes from their federal taxable income, that has quadrupled from $10,000 to $40,000 you can now deduct. You have to be someone who itemizes their taxes, not someone who takes the standard deduction, which has been upped to $15,750. Now, the deduction begins to phase out for people making over $500,000, and it goes back to that $10,000, a previous threshold, if you're making over $600,000. For those who buy a car and want to take advantage of the auto interest deduction, they have to buy a car between 2025 and 2028. They can deduct up to $10,000 in loan interest. And they do not have to itemize their taxes. They can take the standard deduction, which means this is going to help the lower income threshold of society or those in the middle class threshold. It is limited to a qualified passenger vehicle, which means a new vehicle cannot be a used one, bought for personal use and with final assembly having to have been made here in America. Taxpayers with income over $100,000 begin to phase out of that deduction, and anyone making more than $149,000 no longer qualifies for that deduction. Bottom line here, experts say the SALT deduction increase can reduce your tax liability and potentially net you a tax refund upwards of $14,800, while the auto loan interest deduction, that will likely reduce your tax liability or give you a refund about $500 or less. Now, it doesn't sound like much, but when you start to stack some of these provisions on top of each other, if you're a homeowner, you bought a new car, we also mentioned the child tax credit in some of our previous reporting, you start to see how it all potentially adds up. Now, important to note for both provisions, they are temporary. They expire in or before 2029. And these provisions come with some criticism. For SALT specifically, there is an argument that President Trump and Republicans negatively impacted homeowners in 2017 with his tax bill then, limiting SALT deductions to $10,000 when prior to that, you could deduct all of your state and local taxes. And now he wants praise for the approval of increasing it to $40,000. That's not even the biggest concern amongst some tax experts.
There are three main problems with the higher SALT cap. For one, it primarily benefits higher income households. Two, it primarily benefits taxpayers in very high cost of living and high tax states like New York, California, and New Jersey. And three, it pushes taxpayers to more complex tax filing.
For the auto loan interest deduction, according to the Institute of Taxation and Economic Policy, if a vehicle price rises 3 to 5%, the deduction will be canceled out effectively. And we've already seen vehicle prices increase due to Trump's tariffs and trade agenda. Now, while we're trying to give you a heads up of these provisions and how you could potentially benefit, the reality is until you go ahead and file taxes at the end of this year, beginning of next year, and sit down with your accountant and crunch the numbers, that's ultimately when you'll know. Back to you.